The history of money is the story of human creativity and trust. Most money has no value of its own. Its worth comes only from what it can buy at any given time. Long ago, there were no coins, notes, or banks. People exchanged what they had for what they wanted. This system was called barter. A farmer could give rice to a fisherman in exchange for fish, or a potter could exchange pots for fruits. But barter worked only when both people wanted what the other had. If not, no trade could happen. This made trading slow and difficult, and people began to search for something everyone would accept, something that could fill the place of money. In different parts of the world, people used different things as money. On the island of Yap in Micronesia, people used large stone discs as money. These stones were so heavy that they were never moved, only ownership changed. In other regions, people used salt as money because it was valuable and rare. In fact, the word salary comes from sal, the Latin word for salt. Roman soldiers were even paid in salt. In some African and Asian lands, people used ivory, elephant hair, and cowrie shells as early forms of money. These were beautiful, durable, and easy to carry. As trade expanded, people needed something stronger and more lasting. Metal became the standard form of payment. Copper, bronze, and iron were first used, shaped into bars or rings. Metal had its own value and was easy to weigh, so people trusted it. Later, around 600 BC, the Lydians in ancient Turkey made the first stamped gold coins called statas. Soon, other kingdoms made their own coins, like the Greek owl coin, which showed an owl and the goddess Athena. Gold and silver coins spread across continents, and became symbols of power and wealth. But as trade between countries grew, carrying heavy coins became difficult and unsafe. Traders began using paper receipts that represented coins stored safely. Around the 7th century in China, during the Tang dynasty, merchants started using these paper slips. Later, during the Song dynasty, the Chinese government began printing the first real paper money. It was light, easy to carry, and safe to use. From China, the idea of paper money spread to the Middle East and then to Europe. By the 1600s, banks in England and Sweden were printing their own paper money. Paper filled the bill, literally, making trade faster and simpler. With time, modern banking began. People could deposit their money safely and withdraw it when needed. Banks started lending money, helping trade and business grow. Later came checks, credit cards, and debit cards, new ways to move money without carrying cash. In the 20th century, electronic money was born. Today, we send and receive money using phones, apps, and online banking. In India, we use UPI payments. In other countries, digital wallets and online transfers are common. Now, we are entering the age of digital and cryptocurrency, like Bitcoin and Ethereum, where money exists only as code on a computer. It has no physical form, yet people believe in it and use it for trade. Whether it is stone, salt, metal, paper, or digital code, money is still just a symbol of trust. Its value exists because we believe it has value. From giant stone wheels to paper notes and invisible digital payments, money has come a long way. It connects people, powers trade, and shapes history. Every coin and every note you touch carries a story thousands of years old, the story of how human beings learned to trust, trade, and create value together. The journey of money is the journey of civilization itself, from stones and salt to gold and paper to the invisible money of today. Money doesn't just sit still. It moves, constantly. This continuous flow is known as the money cycle, a process that keeps the world's financial system alive and balanced. In the early days of civilization, money existed as gold, silver, or copper coins. Over time, paper money and now digital money replaced them. But no matter the form, Every type of currency follows a similar life cycle. The journey begins with the central authority, like the US Treasury, Reserve Bank of India, RBI, Bank of England, or European Central Bank. These institutions print and issue new currency when the economy needs it or when old notes become too worn to use. In the United States, for example, the freshly printed money goes from the US Treasury to the Federal Reserve banks, and then to Federal Reserve branches. From there, it moves to commercial banks, credit unions, and ATMs, where people can withdraw and spend it. As money circulates, through shops, payments, salaries and loans, it gradually wears out. Banks then collect these old notes and send them back to the Federal Reserve, where they are checked, sorted, and either reissued or destroyed. The cycle repeats when the Treasury prints new bills to replace the old ones. This process happens all around the world. In India, currency flows from the RBI to regional offices, then to commercial banks, and back again. In the UK, the Bank of England oversees the issue and replacement of banknotes. In Europe, the European Central Bank and national banks manage euro circulation. Even in countries with digital currencies, virtual tokens move through central servers, digital wallets, and banks before returning to the reserve systems for verification. This entire cycle, from creation to circulation to withdrawal and renewal, ensures that money remains stable, secure, and trustworthy. Without it, economies would stall and inflation could spiral out of control. So next time you hold a coin or note, remember, it has already traveled through countless hands, banks, and machines, and it's still on its never-ending journey through the global money cycle. But the story of money doesn't end there. Today, money has evolved beyond paper and coins. Banks and central systems now track trillions of dollars digitally, moving instantly across accounts, cities, and even continents. Imagine a single dollar traveling in just 24 hours. It could pay a coffee in New York, fund a shipment in Singapore, and settle a corporate invoice in Germany, all without leaving a server. This is the digital money cycle, faster and almost invisible, yet following the same principle: creation, circulation, replacement, and renewal. Central banks now also use tools like interest rates and reserves to influence how fast money flows. If circulation slows, they may inject more funds. If inflation rises, they may pull money out. Even cryptocurrencies are trying to create a similar cycle, where digital coins circulate, are spent, and sometimes burned to control supply. And here's a fascinating part: every transaction, every withdrawal, and even online payments feed back into the cycle. Banks record them, central banks adjust supply, and the system ensures that money keeps flowing, always moving, always alive. Think about it: every time you tap your card or send money online, you're taking part in this massive, invisible journey. The money you use today could have traveled through thousands of hands, systems, and countries before it reached you. And with every swipe, tap, or deposit, the money cycle continues its endless dance, proving that whether physical or digital, money never truly rests. Bridge back to conclusion. So, whether it's a crisp note in your wallet or a digital number on your phone, money is always on the move. It flows, it renews, it connects us all, linking governments, banks, businesses, and people across the globe. From ancient gold coins to modern digital currency, one thing has never changed: money flows like blood through the heart of civilization. It keeps trade alive, powers economies, and carries on its endless, fascinating journey. And that, my friend, is the beautiful rhythm of the money cycle.